Welcome to our lesson on exchange rates. So before we get into defining what exchange rates are, the reason we need them is that if you think about just within the United States, we all use the same currency. There's no need to exchange money. But if you're to buy something from Canada, well, Canadians use the Canadian dollar and we use the American dollar. We've got to figure out some system to trade currency. If you want to buy something from Mexico, they use the peso. If you want to buy something from Europe, well, they use all sorts of currency, the main one being the euro, and that's in this lesson I'll mainly talk about the euro. So it's not as simple as just buying something from Alabama or Texas, California, or Pennsylvania, where everybody uses the same currency. You have to have some way of trading currency, and the exchange rate defines the price. The exchange rate will tell us how many euros can you buy for $1, how many pesos can you buy for $1, how many Canadian dollars you can buy for $1, and every other currency, right? It's the information that's provided to us by exchange rates. Okay, comparing the dollar versus the euro, on January 1st, 2014, one US dollar could buy about 73 euro cents. Or vice versa, you could think about it, how many euros could a dollar buy? Well, it's the reciprocal. 1 euro could buy about $1.37 in US money. Now these fluctuate over time. One thing that I think would be useful for you is when you are watching this video, go look up what the exchange rate is. There's all sorts of sites that'll give it to you. They're all basically the same value within a half of a cent either way. So for our purposes, perfectly accurate. What are they now? And later you'll be able to tell us whether the dollar has appreciated or depreciated versus the euro. These rates do vary, right? There's going to likely be a different rate when you're watching this versus January 1st of 2014. January 1st, 2008, a US dollar could only buy 0.69 euros. It's a little bit less than what it could buy on January 1st, 2014. But in June 2011, actually, a dollar could buy 1.17 euros, or $1.17. Compared to where a dollar can only buy 0.69 euros, that's an enormous difference. And if you think about products that you're buying from Europe, when a dollar can buy 1.17 euros versus 0.69 euros, in 2008, people in America are paying almost double for a product from Europe. Or if you travel to Europe and you're getting a hotel room that's in euros, because you're going to wherever, France or Italy or some other country that's on the euro, you're going to pay about twice as much for that hotel room because it's charging you in euros. So these can vary dramatically. Now, when other currencies become more expensive, and we're going to say relative to the dollar, you could pick any currency and say relative to that currency. But when other currencies become more expensive relative to the dollar, we say that they have appreciated relative to the dollar. When other currencies become less expensive relative to the dollar, we say that they have depreciated relative to the dollar. So if the other currencies become more expensive, that currency appreciates. If other currencies become less expensive, that currency depreciates. And you'd say the opposite about the dollar. So if the euro appreciates relative to the dollar, you'd say the dollar depreciates relative to the euro. So if you're comparing two countries, if there's depreciation of one country's currency, the other country's currency is appreciating. Just the terms you'll use. If you follow news reports about the dollar, these are terms you'll hear a lot. The dollar appreciated or depreciated. If the government attempts to set the value of money, which sometimes some governments will, devaluation is where a government tries to reduce the value of a currency, and revaluation is where a government tries to increase the value of a currency. So why do exchange rates vary so dramatically, right? The value of the euro to the dollar within the past 15 years, well, since the euro's existence, basically, it's been a pretty dramatic shift, right, in how much the dollar is worth. Uh, the euro and dollar and the price of the euro, or the price of a dollar, the price of a euro in dollars or the price of a dollar in euros, is determined by what are called floating exchange rates. These are exchange rates that aren't set in stone. They float, right? They vary. And they vary based on law of supply and demand, determined in free markets based on the law of supply and demand. What affects the supply and demand of a particular currency? Well, there's three main things we're going to discuss. All should seem pretty logical. If people in the US wanted to buy more products and services from a foreign country, first they would need to get the currency from that country. Demand for a country's exports is going to lead to demand for its currency, and it should lead that foreign currency to appreciate relative to, if we're using dollars, then the dollar would depreciate. So demand for a country's exports should lead to demand for its currency, and that currency of the exporting country should appreciate. Demand for financial instruments, so demand for stocks and bonds in a particular country. The more people would like to purchase stocks and bonds in a country, the more they need to get that particular currency. Right? If everybody wants US bonds, you're going to have to be buying dollars first. Right? The dollar should appreciate. So demand for a country's assets leads to demand for its currency. And demand for physical assets overseas. So if Coca-Cola wants to build a new factory in a particular foreign country, right, if they had to buy that, they would be exchanging on the local currency market, increasing the demand for that country's currency. So all of these, I think, are pretty straightforward. Whether it's goods and services or financial instruments or physical assets, you first have to purchase the dollars or the euros or whatever currency is that country's currency. That should appreciate the country's currency that people are purchasing. If currency appreciates, the fluctuation, these exchange rates have a huge impact. So if the dollar appreciates, what would happen to imports and what would happen to exports? It's a pretty big things here, actually. So if the dollar goes up in value, all of a sudden products from foreign countries are cheaper for Americans. So what would happen to imports? Well, we'd likely buy more imports, right? The dollar has more value. Foreign currencies are cheaper. It's cheaper for us to buy foreign currencies, so it's cheaper for us to buy foreign goods. So if the dollar appreciates, we will import more. Exports, on the other hand, right, since the U.S. is exporting products, it's more expensive for other countries to buy the dollar. So now all of a sudden U.S. products are more expensive than they were before. We would expect exports to fall. So if the dollar goes up in value, we see more imports, fewer exports. Actually, so our net exports would shrink. Opposite case if you see a depreciation in the dollar, of course. But exchange rate shifts, this is a pretty huge impact on trade. 5% shifts one way or another can make products 5% more expensive. And while you might think, 5%, who cares? Well, 5% can matter quite a bit, right? We know, the laws of supply and demand hold. It certainly depends on the elasticity, but high value items especially, right? If you get a 20% shift in a currency, which is not unheard of, imagine if you're selling cars, right? $20,000 car now costs $24,000. It's a pretty huge difference. Exchange rates can have an enormous difference, whether it's appreciation, which we just looked at, or depreciation, which is the opposite case. How does this matter? Well, I'm hoping that in going through this you can see how it matters. But there's one major product that is definitely influenced by the strength of the dollar because we import a lot of that, and that's oil. Right? A lot of the gas price fluctuation occurs not because the price of oil fluctuates wildly, although it does fluctuate, but because the value of the dollar can fluctuate. If the dollar gets weaker, it's going to be more expensive for us to buy oil, more expensive for us to buy gasoline. If the dollar gets stronger, it's less expensive for us to buy oil, less expensive for us to buy gasoline. So gasoline prices, and part of why they might change dramatically, is certainly not the only reason. There's a lot of other factors. But one of the reasons would be exchange rates and exchange rate fluctuations.